here's a preview of the performance of the 3 strategies I'm going to be covering in this video. The first strategy beat the S&P 500 by almost 100%, the second strategy beat it by almost 250%, and the third one by 263%. This is not clickbait, there's no trick, all the data is public and verifiable. So let's get started with the parameters and variables I'm going to be using for these 3 strategies. We're starting with the $5,000 capital. Right off the bat, we're not here to make millions, we're here to make money. And we're here to do that in a disciplined, consistent, and mathematical way. I purposely decided to start off with a relatively low amount of $5,000 to show you what's possible when you follow a strategy to the T, but you still need to remember to never invest more than you can afford to lose. Next parameter is a $250 position size. Again, we're not here to make crazy bets and risk losing it all. This is the money you invest every time you identify an opportunity. We do not invest more than this amount for any opportunity ever. Traders who go broke don't stick to rules and parameters. We do not invest in opportunities we can't afford, so that means that we never buy a share if it's above our position size of $250. Next parameter, a 1-to-1 margin factor. This means we need to provide the money up front for any trade we want to make. As an example, a margin factor of 2-to-1 would mean our broker allows us to make a $1,000 investment by only providing half of the amount. And that's a big no-no. This is debt with dangerous leverage, and it's a recipe for disaster, especially for beginners. We do not borrow money from our broker ever. Next parameter is a profit target of 15%. In the strategies mentioned in this video, we're never looking to make more than 15% profit per trade. And we could go for a lot more, but we don't want to be greedy, and the sooner we cash out, the earlier you can guarantee your gains. We also have a stop loss at 10%. This means that as soon as we've lost 10% of our investment on any trade we're making, we absorb the loss and we sell back what we can. This enables us to stay flexible with cash at hand, and it also minimizes our drawdown. What is a drawdown? A drawdown refers to how much of an investment or trading account is down from the peak before it recovers back to the peak. Our max drawdown across all strategies is 33%. We only lose money from previous peaks, not from our original $5,000, which is a good thing. In order to compare the efficiency of our strategy, we need to compare it against a benchmark. The S&P 500 is one of the best performing, most robust, and most reliable indexes out there. Very few people manage to outperform it over a long period of time, so we'll use it to compare our results over the past 10 years. In this period, a simple one-time investment in the S&P 500 would have yielded a 166% return on investment. If we can do better than this, we beat our benchmark. We only invest in reputable stocks that are part of the S&P 500. It's important to not confuse our benchmark with our portfolio. Our benchmark looks at how much money we would have made if we had decided to invest our $5,000 in the S&P 500, sit back and watch our account grow. Our portfolio, on the other hand, is where we actually invest our money. And because we have a low profit target and stop loss, it's constantly evolving. We buy and sell shares of company within the S&P 500, but we don't passively let the money sit there. We invest and cash out based on signals and patterns. Patterns are a fundamental part of all 3 strategies. Patterns are the distinctive formations created by the movements of security prices on a chart. Chartists seek to identify patterns as a way to anticipate the future direction of a security's price. Patterns are the foundation of technical analysis. We rely on patterns for 3 main reasons. Number 1, we look in the past to predict the future. If a pattern happened 100 times in the past and triggered the same outcome 87 times, it's very likely the same outcome will happen the next time the pattern comes along. Number 2, in the framework of trading, patterns very often, not always but very often, obey mathematical rules. There is nothing more accurate, reliable, and predictable than maths, so this is another good reason to trust patterns. And finally, number 3, as accurate as one can be, patterns don't always output the same result, and they sometimes cause us great losses. Just like in life, sometimes things don't go as planned and we take a loss, and that's okay, because patterns always teach us at least discipline. They are like habits. They teach us to stick to the plan, only act when the time is right, and have a backup plan when we turned out to be wrong, and that's our 10% stop loss. In order to backtest our strategies and analyze results, we will be using Wealth Lab. Wealth Lab is a very powerful tool that has decades of historical data across many different markets, hundreds of indicators, and a community that posts ready-made strategies to try out. All along this video, I'll use screenshots from the software to support the strategies and their results. You should now have everything you need to get started, so let's dive into the strategies. Strategy number 1, the gap down with a 257% profit. This strategy uses a very simple pattern. Anytime the price of a stock opens the day below the previous day's low, we invest $250 in that stock the next day. This is how you build a strategy in Wealth Lab. It's very straightforward, and here are the results also from Wealth Lab. So looking at the profitable trades, it took us on average 51 days from the moment we buy the opportunity to the moment we sell it and cash out our 15% profit. This is called our average position held time. Looking at the losing trades, it took us on average 36 days from the moment we buy the opportunity to the moment we sell it at a 10% loss because we're in the red too much. On this chart, you can see the distribution of trades, and we see that most winning trades resulted on a 15% profit and a few resulted in more. That's when the stock jumps up so much from one day to the next that we don't even have time to sell at a 15% profit. We have to wait for the market to open and sell at a 20, 25 or even more profit. It's a good thing, but again, we're not doing this intentionally. The timing of the market was in our favor, and that's great. We're looking to get out as soon as we hit 15% in profit. The opposite can also happen for losing trades, where sometimes the stock drops so much from one day to the next that we didn't have time to sell at a 10% loss, and we have to sell at a 15 or 20% loss. This time, the timing was not in our favor, and we lost more than we had planned for, but that's just part of the game. Here is the breakdown of monthly returns for the past 10 years for this strategy. We see that except for 1 year where we performed substantially worse than the S&P 500, we beat the index almost every time. And finally, here's a quick overview of one of the most profitable trades for this strategy. It was with the Biogen company, where we entered at $202 per share on May 25th, 2022. Important to note that since our max position size is $250, we were only able to buy one share of the company, but that's okay. And later we sold at $283 for a 39% profit. Strategy number 2, 5% drop or more, 415% profit. Again, very simple pattern. Anytime the price of a stock opens the day 5% below the previous day's close, we invest $250 in that stock on the next day. This is how you build a strategy in Wealth Lab. Again, very straightforward. And here it's important to note that, especially because we're investing in 500 of the largest companies listed on the American Stock Exchange, we're not looking at extremely volatile stocks here. In the context of the S&P 500, a 5% day-over-day decline usually means a panic sell following some bad earnings report or some bad press around the company, because big stocks don't usually just drop 5% out of nowhere. A great example of this is the recent 10% drop in Google's stock price due to the bad press around its newly released AI Bard. The stock just completely dropped after the AI made a blunder during the presentation, but it picked up a few days later. It hasn't fully picked up just yet, but it probably will in the near future. So this was a good buying opportunity. Looking first at the profitable trades for this strategy, our average position held time was 37 days, and for the losing trades, it was 25 days. On this chart, you can see again the distribution of trades, and here is the breakdown of the monthly returns for strategy number 2. Again, here we see that except for 1 year, we beat the S&P 500 every year. In fact, we did over 3 times the index performance in 2016 and nearly twice the performance in 2014. It's very impressive, but watch the video until the end so you can understand exactly how this is done and how none of this is actually easy at all. It's far from easy. If it was easy, everyone would do it. Here is a quick overview of one of the most profitable trades for this strategy. It was with the company Royal Caribbean Cruises, where we entered at $53 per share on October 29th, 2020. That was during the pandemic. Again, since our max position size is $250, we were only able to buy 4 shares of the company, and 2 weeks later we sold at $75 for nearly 41% profit. Strategy number 3, 4 consecutive down days, 429% profit. Again, another really simple pattern defined as follow. Anytime the price of a stock closes lower than the previous day's close for 4 days in a row, we invest $250 in that stock on the next day. Again, most stocks in the S&P 500 don't just drop in value for 4 days in a row, and when they do, they recover for at least a day or two. They might keep dropping after that, but looking at a short-term investing horizon, we'll make money if we hold for a few weeks or months. This is how you build a strategy in Wealth Lab, and here is a look at the profitable trades. Average position held time for profitable trades was 53 days, and for losing trades it was 36 days. Here we see the distribution of the trades with over 1,500 winning trades and more than 1,300 losing trades. Here is a breakdown of the monthly returns, and again we see that we do better than the S&P 500 almost every year. So what the hell is going on here? How can this be? I just showed you 3 strategies with 257%, 415%, and 429% profit. That's more than triple the performance of the S&P 500 over 10 years. How is this possible? How is this not common knowledge? And if it's so easy, why isn't everybody doing this? Why isn't everybody trading, making tons of money? Well, it's because it's not that easy. Again, I didn't lie to you. You can check all the data online. This is public and accessible. Wealth Lab has a free version. But in the next part of the video, we're going to be going through a few caveats and reminders about why it's not that easy to make money on the stock market. Caveat number 1 is fees. Almost all reputable and regulated brokers charge fees for transactions. In fact, you should stay away from those who don't. It's normal for a broker to charge fees for a service they provide. In this case, giving you the option to invest across dozens of markets around the globe. The more you make trades, the more you pay fees, and this matters even more in our case because we only make a few tens of dollars in profit per trade at best. And so usually you'll have to pay fees when you buy shares, when you sell them, and sometimes when you want to transfer your profit to your bank account, although that's not as common. Brokers also charge an exchange fee when you buy shares in a currency different from your trading account. There is an option in Wealth Lab to include commissions as a flat fee, a price per share, or as a percentage of the trade value, just to kind of anticipate how the fees are going to affect your profit. So overall fees will lower your net profit, but that's just part of the game, so deal with it. Especially when you're doing a lot of trades, you're gonna have a lot of fees. That's just how it works. Caveat number 2, taxes. When you make money on the stock market, you'll often have to pay the capital gains tax unless you live in a tax haven. And the capital gains tax ranges anywhere from 20% in countries like the US to over 40% in countries like Denmark. You're only taxed on your net profit and you can write off your losses every year, but paying your taxes is again part of the game. Most reputable and regulated brokers are required to report your account statements to tax authorities every year, so don't try to run away from it and pay your taxes. When you make money, you pay taxes. And lastly, the most important caveat of all, trading is a full-time job. So if we look at the Nasdaq and NYC market, the 2 primary ones in the US, the opening hours there are from 9:30 a.m. to 4 p.m. And for some strategies mentioned in this video, like the gap down, checking the pre and after market trading hours activity will be crucial, and that's from 4 a.m. to 9:30 a.m. and from 4 p.m. to 8 p.m. And if you think about it, this requires you to spend more time on your laptop than the regular 9-to-5 job, at least if you really want to get good at this. Of course, you can decide to only spend 2 hours a day trading and only look at the signals for the next day in the evening and to not put 100% of your focus into this. But if you do that, you'll most likely miss out on a lot of opportunities, and the success rates mentioned in this video only apply when you invest in every pattern, not half of them or not even 75% of them. If you only invest here and there and don't have a disciplined approach to this, you may get unlucky and only pick the losing trades mentioned in this video, for instance. So yes, applying the exact strategies mentioned in this video would have yielded the profit percentage advertised in this video. That's if you had followed the strategies to the T for 10 years. But no, it's not that easy, because if you want to be successful in trading with those strategies, you need to consider it like a job and develop very strong self-discipline. There's no such thing as easy money in this game. Thanks a lot for watching. Don't forget to like, subscribe, comment if you enjoyed this video. There's always more to come. I'm also thinking of releasing a newsletter around the trading patterns and signals mentioned in this video based on the strategies mentioned in this video. Feel free to sign up here. You will get notified when that goes live. So check that out if you're interested. Thanks so much for watching. Thanks so much for your time. See you next week. Enjoy the journey you're on.